Welcome back. You're watching Bloomberg Bottomline. The spotlight is on the impact the yuan devaluation is having on the currency markets and its resultant impact also on the equity side across sectors. One sector that is particularly going to be impacted by this is, of course, the steel industry. And we saw the government step in with a duty hike, a second import duty hike of 2.5%. But what does this really amount to, and does this really help a lot of the beleaguered steel companies? Well, to make sense of it, Rahul Dholam of Angel Broking joins us now. Rahul, my first question to you, first of all, thank you for joining us. My first question to you is that the latest round of import duty hike, how substantial is it? Does it ease the pain even a little on the ground?
Well, if you see, there's been a 2% depreciation in the yuan, and that's barely taken care of by this import duty hike. So it's something a little too late. I mean, we heard the JSW Steel management asking for duties of up to 40%. So you can make out how much 2.5% is compared to that. The import pressure is not receding. I mean, if we look at the first quarter numbers, we had an incremental consumption of steel in the country of about 1.3 million tons. It increased 7% year on year to 20 million tons. Out of that 1.3 million tons of incremental consumption, the net incremental imports of steel into India were 1 million tons. So you see roughly 75% of the incremental consumption is catered to by the imports. That is the kind of pressure that we're seeing. Again, we have to remember that these import duty hikes do not apply to the FTA countries. So out of this 1 million ton of incremental imports that I'm talking about, roughly 75% have come from China, Japan, and Korea. So Korea and China have actually increased 50%. Japan and Japanese imports have doubled. So these FTA countries are going to continue exporting to India, and that's going to be taxed at just 1.2% probably. So that's not going to help imports from these countries. So we do not expect import pressure on steel to recede anytime in the near future, unless the government takes some drastic action on that.
Right. Let's break it up, Rahul. I'm going to ask you a separate question. Really on Tata Steel because the numbers are out and the stock has had an impact. But I'm going to start by asking you, if you were to break it up between the listed steel companies, how does it stack up? Who is most susceptible to it? Because many steel companies have been going up the value chain to try and circumvent this issue of dumping by Chinese steel producers. So what is your impact analysis throw up?
Right, so what is happening is the biggest steel players are able to somehow retain their volumes. They are actually increasing their volumes. And because the incremental consumption is being taken care of by imports, it's really the smaller steel mills who are having, especially old technology steel mills, are the ones who are suffering. And there will come a point in time where they will have to start shutting down one by one. I mean, if we look at the debt, for example, excluding the top four, it is estimated that the total debt of the smaller steel players should be roughly in the zone of 1.88 trillion. That's 1,80,000 crores. Roughly one third of this, so 55,000 crore of this is stressed from the banking sector. So that is the kind of stress that is there right now, and if prices deteriorate any further, it's going to further increase the stress, and that's going to be a big drain on the economy as well.
Right. So which are the most susceptible, you think? What would you not touch right now with a barge pole if you were to advise investors?
I think right now with the pressure on commodity prices, we're not touching any of these steel stocks. We don't have a buy recommendation on either of these steel stocks here. JSW looks the best placed in terms of their balance sheet and also the non-integrated model. But even their upsides are limited in terms of our SOTP valuations. So right now we're having a neutral rating on all these stocks. We don't have positive views on either of them.
One last question. Okay, Rahul, last question on Tata Steel. The numbers were bad, but the markets seem to be looking more at the valuation and also the expense management that the company has been able to do. As an analyst, what's your call on Tata Steel at these levels?
Well, on the standalone basis, what we saw was they had high-cost iron ore inventory, which we expected them to utilize much more than they have in this quarter. So that has resulted in raw material expenses coming a bit lower than what the street was expecting. And that has really boosted the EBITDA margins. Also, some of these subsidiaries, the others and eliminations category that they have really outperformed, and that is based mostly on currency fluctuation, forex impacts. In terms of Europe, the margins have really declined from $45 roughly per ton to now about $27 per ton, and that's a steep decline. So it's a mixed set of results. On the standalone basis, yes, they have outperformed, but we'll have to wait whether this is recurring, because if the material costs can further decline for them. And in terms of Europe, we'll have to see if they can pick up that EBITDA per ton. Otherwise, it's going to be a really deep cut in the valuations.
Okay, we're completely out of time, Rahul. We'll have to leave it there. Thanks so much for joining us. That's a wrap on this edition of Bloomberg Bottom Line, but we'll be back with all the top stories after this short break. Thanks for joining us. Goodbye.